Hey folks, welcome to this special conversation. Now, every year at this time, we are in the KUSCCO FY earnings season as well and talking about dividends and everything. But this year, one conversation has dominated every household because KUSCCOs are virtually in every household. And that is the question of exposure to KUSCCO. And we are privileged now to sit down with the man in charge of the KUSCCO Sasra, that is the regulatory authority which oversees, the last I checked, about 174 entities. And that is Mr. Peter Njuguna, CEO. Karibu sana.
Thank you.
Thank you for taking time to speak to us.
Yeah, thank you. My pleasure.
Peter, let's start from here. You have a vantage point view. What is the scale of exposure that we are talking about in terms of the entities you oversee and regulate with regard to KUSCCO? And I'm saying that because many of us are not familiar with the architecture, that KUSCCO is actually not Sasra regulated, but now the entities you regulate have exposure in KUSCCO.
You're right. Thank you very much. Indeed, we have, an obligation through the institution we regulate. We do regulate actually 350 institutions. 2024, 2025, we had 355. And I think the numbers now, those numbers are the right one to use because from there we have been able to track right from 2021 to see how that situation is unfolding, how much exposure I could ask. I think 2022 we had about 18, actually almost 19 billion placed in the union, which they had a product called Central Finance Fund, which collected deposits. But that has been declining. 23 it came down. 23 came down to about 14 billion. And therefore, we are looking at a figure from the time, we remember our inspection, we never completed, but we had 14.6 billion. Now, I think we've seen the reports because of the work that was done by PwC, who are there now to do forensic, because we realized when we did our work, and the commissioner did, there are issues we could not answer, so they had to do deep. Because some of these investments have dated like 10 years, investing and investing. But to answer your question, you're talking about 14 billion exposure, which is about 10% of the capital. And actually that is, you look at 2023 numbers, meaning 2023 would be less, maybe less than 10% of the core capital. Okay. And I say core capital because the capital is a very, very important defense against losses. So you're looking like if it's 10%, then we'll wipe out the capital for the KUSCCO industry by 10%, meaning that because of the prudential regulation, capital, a very key thing, noting that that's the second line of defense. We have the first line as provisioning. And that's why we are pushing for the first line of defense. We are saying, look, provide. So that you also cushion depleting your capital. Okay. Yes.
I'll be coming back to provisions, but let me walk you back to something you've touched on, and that is the letter that came from the then CS for Cooperatives, Chelugu, in October 23 to your office.
Absolutely.
Indicating that we would like you to conduct an inspection on KUSCCO.
Right.
And we had conversations about this at the time. And I'm just wondering to myself, are we dealing with a situation which we could have averted or at least mitigated better than we currently have?
Yes, I would say one, the conversation, the letter you saw was culmination of engagement. Sasra, we monitor the performance of our SACCOs and you could see the exposure. And I'll also step back and say, look, the law actually provides that SACCOs can invest in non-government securities, and that means, but that is capped, meaning they can place monies in listed companies, they can place money in KUSCCO, and other institution, what you call national cooperative institution, but it is capped at 40% of their core capital.
Yeah.
Okay, so to title of it, we could monitor that. And increasingly we realize that they're increasing that. So for 2021, we started engagement, exchange letters. KUSCCO even at some point told us, look, we have now restructuring our business to separate the financial business so that it can come under regulation. But at the same time, they were saying, remember, the KUSCCO Societies Act does not regulate us as a secondary institution. Yeah. It is designed and framed to regulate primary. So when we realize we're having policy kind of discussions, then it's when we actually wrote to the CS around that, early that year, first quarter of that year, explaining the journey we have worked and the fight we are not fighting, because we wanted to resolve it in a way that, look here, it is for your own interest, you get under regulation. Remember, They had already hived off a risk management fund, which was doing insurance of credit loans and the like.
Yeah.
So they hived off that to an underwriter, insurance company, under IRA. And we told them, look, why don't you now hive off this business? We come. So that was it. But when they refused, then we wrote a letter, said, look, I think policy intervention is required at your level. And that is all culminated now to that letter. And indeed, I would say if the journey we walked, there was, I think, commitment and willingness on the part of the union, we would be talking about a different story today.
Okay.
Yeah.
Let's talk about provisions. When I come through the various annual reports which have come through so far, and largely from the big entities in the SACCO space, it looks like there's variation in terms of how provisions are being made. And I ventured to ask one SACCO, if you look at IFRS 9, it is very clear as to how elevated credit losses should be provided for.
Yeah.
You take the hit up front. And the logic is that you don't want vulnerabilities to manifest further down the credit cycle. There are those who are staggering it over years. There are those who are taking it up front.
Right.
Has there been any guidance from Sasra as to how to go about provisions?
Absolutely, yes. We did give guidance. This circular we gave this year. And I think for us, what we are doing is simply to remind SACCOs that you have an obligation under the law and under the financial reporting standards to actually make impairment reserves for this. And I will say this, when you refer to IFRS, there is expected credit losses, and which speaks more to the loan, which has a tenor, 1 year. But these are investments, which you had a clear, it's like a fixed term deposit, which you expected to be paid on a certain date. So it's true, they have crystallized. The question you're asking yourself, how can I recover something? As that conversation happens, because there is about estimated 5 billion and other assets that have been looked at that can be used to mitigate the losses, then as you do that, you need to make provisions. Now, our guidance, we gave the guidance, but allowed our space, regulatory discretion, where we are able to say, look, SACCO A can absorb, or depending on the quantum they had put, they can absorb the losses based on the revenue for the year, because they have to charge this year, or the capital buffer they have. So we give that room because there are different levels based on the scams of the business. And therefore, that's now where you find the variation comes in. Some of them are taking the hit one-off. Others are spreading 2-year, 3-year. And why was this important? SACCOs we call them people's banks. It's you and me who own them.
Yeah. So
these are not sophisticated investors. So there is adverse information, like say, us saying charge once, comply with the IFRS 9. Then we say, look, what would this mean for the member depositors in that institutions? It means they will interpret that information in a very extreme way. And that can cause a run in terms of deposit. It will cause the risk to going concern of the institution. So, and secondly, you are talking of a situation that is affecting the entire industry.
So, Peter, you're talking about guidance in terms of provisions and a scenario which affects the entire sector.
Absolutely. So when you realize the impact it's across the industry, then you can see you can cause an industry crisis that clearly from where we sit and looking at the law, it gives certain discretion to stabilize the industry. And I think that's normal. We've seen even other regulators, you accommodate that. It came in during the COVID, where we had to give certain regulatory guidance, respecting all the standards to contain the situation. And that's how we looked at it. And therefore, in applying this guidance we've given, that's where the ability of the institution is coming into play. And here is basically to tell the members, look, yes, there is least losses, exposure that your SACCO has, but it should not affect the member. Yeah? By way of, so provision take off from your income, you may receive a reduction in limit, but that is better. You better suffer that now. Be assured that your deposit will be there, and the SACCO has the liquidity to actually continue, funding, loan book, and the like, so that the core business can continue. And then also, you also want to protect capital to a certain degree. But some of those who are, and there are also instances we realized that when you impact these investments, some of them were capitalized, say, dividend or the return from those investments were being plowed back. There are some who will tell you, yes, we have 200 million, but 40% is interest that we plowed back, reinvested. Now, so that allows conversation with the auditors. Is this a prior year adjustments or is it a knock-off direct? So we left that conversation, and as they come to us, they are very clear. We want to treat this because this is what we are seeing. So that's really the guidance could not be very, very specific. We left that room to discuss by case. And I will say that those who have made full provision here is that through earnings. There are some who have gone to their capital. We are okay with it because that's why capital, they say, we will not, because of we have the capital, so we have unpacked, charge what we had accrued over years, prior adjustment, and the capital, we are okay. Because I think we didn't want to cause a crisis after a crisis. So that's really why we are handling it that way.
There are about two or three entities that I've read their annual reports and they've indicated we've written off.
Yeah.
And I wondered, isn't that a write-off coming too soon, considering this is a matter still under investigation? And possibly, is it a statement that the sense is that, especially from a regulator standpoint, that there is no hope for recovery here?
I think 2 points to that. One is the understanding of when you say provisioning. Some, they could have written off everything.
Yeah.
Because a write-off, you need to provide first, then you actually go, because for reserves, you carry them in your book, and you obtain liquidity. Now, when you go write-off, it means you have gotten members' approval. I'm not sure we give you those approval, because write-off of assets has to go to members. Secondly, is the point, so there is the issue of understanding. But also, if for any reason they get that approval because the amount is insignificant, it means there is an opportunity for writing back. In accounting, financial, there is a way you write back such losses. So I think it's not lost for them. They are saying, we want to forget this, we ever invested here, and we are ready to, so it's okay. But when should anything be recovered, however retro, because those are conversion going on from the assets, and whatever they can recover, then the turnaround strategy, then it can actually be, there are mechanisms to write that back. So it's not that it's lost.
Okay.
Yeah.
And from where you sit, are you optimistic anything could be recovered here?
One, these cooperative institutions are very interesting because they are owned by all these institutions. One thing is that KUSCCO is very key. And remember, KUSCCO was founded as an advocacy body. Correct. To do training and lobbying for their members, just like we know other industry bodies do. I think this venture into financial services business is where we feel it should not have happened. And therefore, as they have the conversation about their core business, this conversation about what can be recovered, I think they can recover something, but not 100%. I don't think that would be possible because you're talking of those billions. And the assets that are being talked about is about 5 point something billion. So that tells you, I mean, there's no those assets, where would they invest to earn enough to actually earn? So I think something is, but not everything.
I see.
Yeah.
Still on provisions, Peter, I'm wondering where ISPAC comes in all this conversation.
Yeah. I think one, ISPAC, we operate, ISPAC is very clear that Kenya, we adopted international financial reporting standards.
Correct.
And, therefore, when they adopt that, it means the moment IFRS 9 or any other guidance comes in, we have to comply. But remember, there is also that you realize in financial reporting, the responsibility lies in the board.
Yeah.
The auditor comes to give the opinion. But luckily, all these are their members, both of them, the financial preparers and the auditors. So they have a conversation. And I think I've been called by, how should we, the auditors and all, and the what ISPAC, and he said, look, I think there caused a decision to be made. We understand the IFRS 9. So if you discuss with your client and they are whatever way, then we are okay to hear. But what we say is, for us to be able to compare like with like, we have regulatory guidance. So at the minimum, can we have regulatory guidance compliance? If you find you're able to absorb compliance with IFRS 9, so be it. But at the minimum, so that, because again, the modeling for IFRS 9, expected credit losses, probability of default and all that, there's a judgment. A model has a lot of the assumptions you make and all that. And we have seen tendencies where people will make very favorable assumptions. And that's why this providing regulatory guidance becomes important, for you able to make sure that you don't underprovide. And also the reality of the business is considered. But we expect, and we have done this in the past, where we have seen those, because when we took over as a prudential regulator, there are historical legacy issues we had to deal with. We had to also have the same conversation when we clean up the balance sheet over time, or inject capital. And we have seen at the end of the day, a very good understanding from the auditors, and they prepare us. And I think for us, it's a huge opportunity we have to make sure, look, even building capital is very critical, okay? Because that will have enabled us to just write it off. I mean, provide one-off, then now you wait for the recovery. But we're in a situation where, as an industry now, those years, we realize that the change in the business model has not been as fast as we would have wanted. Why? Because unlike other institutions where they can hire experts in the board through independent directors, here is a situation where you have directors changing through election over time. So you realize that affects the momentum, the speed of the changes that you'd want in the business strategy. And therefore, but where we have had consistency, people we licensed 5 years ago, 2010, 11, and they dealt with these legacy issues, you'd find some of them had very little, if any, investments in that. But those people, things have been okay. They're also bullish because the quantum of investments was also a function of, one, the size of the institution, the free floating cash after lending to members. So they were also taking bigger risks to investing more money.
Yeah.
But I also hasten to add this, Julian, that this investment, like I said, are across. Our analysis is that over the last, and I think it's in our SACCO supervision report, that pushing the buttons has helped also what you call government securities change. I think we saw a huge shift the last 2 years in government securities and reduction. Like 22, we started pushing down. I think the market was also now sensing. Yeah. We started winding down in KUSCCO. That was evident. And it was not good for us because it was assumed it is us who are discouraging these SACCOs from investing there. Yet we were asking questions, not telling them, yes, where are you putting your money? And so out of that, some of them made decisions that in the boardroom, we'll only invest in regulated entities. If it's not regulated entities, we'll put this retro as from, affiliation or just providing support to an institution that is in the cooperative sector. It's, I think, the scale of change that was a little slow. And like you said earlier, it would have been better if the changes we were pushing from a regulatory perspective were taken earlier.
On that point of risk appetite, Peter, I've always wondered, because if you look at the capital market side, for instance, the pension benefits, there are very clear ceilings prescribed by RBA in terms of how much risk you can take on in certain asset classes which tend to be very volatile, private equity, real estate, etc. Do you think that, one, we seem to have had a failure on that part in the SACCO space, and is it an opportunity to revisit that conversation on tightening?
One, I'll confirm that we also have limits. Actually, we have limits on how much you can put in an earning assets, say buildings, equipment, and the like, and properties. And we do have limits on non-government investments. When you invest in government securities, no limit, so long as your members are not complaining. But you have limit now. When you put listed companies, investment like where they were putting, there's a limit. It's at 40% of the core capital. So it was there. Now, and therefore that gives the board's space to actually conduct due diligence. We shall put in this entity, we shall put this entity. Now that is what we expected them to do. But now the lesson we are learning is, look, I think we left a space where they also went too far, given what we have seen. Because we see the last 23 and 24, we have now seen a shift in a lot of regulated investments, asset management firms, government securities. It's a good thing. And therefore, we may, from where we sit, and also 2020 regulations, we became very prescriptive in non-government financial investments. In fact, for them, they have to take to members, get approval, and we have to approve before it's getting to members. So we're also learning. Here, the difference was, these were term deposits. And these entities will tell you, we used to place money, and every year around Q1, when we are paying our dividends and interest on rebate, we'd get back our money. And we have done that for the last 10 years. So what went wrong? So like any business, I think that's now what the forensic audit has given indications, how things went bad. And, that's really where the conversation will be there. How do we learn from here? But clearly from our side, there are lessons. One, mixing advocacy and financial business is a no. And like I told you, we did our policy proposals back then. Luckily, it is already with our minister. And we know he has, I've heard him say that it's on its way to the cabinet, so that any entity taking secondary SACCO, because like there has been debate, does the SACCO Societies Act apply on secondary SACCOs? That is a SACCO whose membership is actually legal persons, not the primary SACCOs. There has been that gray area, like you rightly observed. And that, I think, is one we are sealing. Nobody will collect money without that. So I think there are lessons certainly to pick, but the ceilings have been there. Only that in the exercise, just like you said, other sectors, the board all are left, the governance board are left the latitude. How do you place your money? Now, there is this regulatory ceilings, but your risk appetite will take you, I can put more here, I can put that. I think that was not, properly, implemented.
Okay. Yeah. Peter, don't you think, and I think you and I have had this conversation in the past, the fact that we have the Cooperative Societies Act, and then we have the SACCO Societies Regulatory Act running parallel, then creates a perverse outcome in the sense that we are now in a situation where an entity like KUSCCO, secondary player, has been exposing primary players under your watch. Don't you think it's time we had a conversation about consolidating these two frameworks?
I would say yes and no. Yes, because the SACCO business is financial deposit-taking business. Yeah. So certainly there need to be clarity. But also, Cooperative Societies Act is an incorporation act, first and foremost. Just like we have Companies Act, which incorporates those kind of business in financial space. Then they go for the business regulation to the relevant statutes. And I think that's where we are mixing the two, that cooperative society has to define the incorporation and the governance, AGM, how they are run, that's their space. Whether a SACCO should have delegate or membership, that's their space. Now, when it comes to the conduct of this business, SACCO business, then things should be squarely. That's where the clarity is required. And I think there is no debate about that. It's been very clear because I think what the Cooperative Society is, the bill in Parliament 2024 is already gone through the National Assembly. It's actually going to the Senate now. It's actually in the Senate, sorry. And it gives clarity that this, kind of commingling of businesses, because members, have asked. And it's unfortunate, I must say, because even when SACCOs came, SACCOs started, then members would push the limit. They would take more business, even, without careful analysis of the risks. And remember the regulation, even Sasra Act came much, much after force of business had grown. So I think we are finding ourselves that we left this space of secondary, where now this commingling, financial advocacy, it creates certain very serious conflict. And I think that's where now the Cooperative Societies Act and the SACCO Society, there is consensus. Secondary SACCOs they have a place in the SACCO ecosystem, but it has to be regulated. And I think the law recognizes that. But also there needs to be clarity. And I think that's now where regulating Cooperative Societies Act may not define the whole spectrum of risks, because it's a small SACCO registered today or a corporate registered today, whether it's a dairy, artisan mines and all that, I think it will still have a big role to play. I think the issue is it has recognized that now we've been having 4 3-tier system. We have the unions, then we have the apex. I think it has now 4 tiers. Primary, then you go to secondary, which can do wholesale business with their members, but they have to be regulated. Then you have a federation, which will do advocacy and training and the like. I think that bill also is a piece that has taken a bit of time. I think for the last 10 years, been conversations, and I think this underscores that when policy reforms start, they should be fast-tracked, because we are looking at a situation where, like you write, if some of these policy reforms were concluded, I think we'd be having a different story. KUSCCO would have separated maybe the last 3 years, their business. So I think it's a push for us that when policy reforms start, by the time you are doing policy reforms, you have seen a policy gap. Yeah. So, and you have seen, if you're not sealed, there's going to be a problem. So I think that for us, as from, as regulators, policymakers, is can we fast track it? And I think that's where the challenge is for us. At times, the reforms in the cooperative sector take ages to go through.
Okay. Yeah. I've got 2 final questions and we dial down our conversation. 1, SACCOs have analyzed their annual reports and have looked at the scale of impairment charge they are taking in light of KUSCCO. Yeah. And it's really outsized. And I've wondered to myself, could some, and being the regulator, I'd imagine you have a view of this. Could some be taking advantage of the situation to clean up the house, if I could call it, tidy up your balance sheet and ensure that you're tidying? Then the numbers could be more than KUSCCO, in my thinking, for a few players.
You're right, and it's a wake-up call. I would say it's a wake-up call. I think we've seen KUSCCO what has happened, looking at the numbers, the investment, because there is remember, nearly 80% of the assets of SACCOs are held in loans to members.
Yeah,
that's an area we keep very, very close, because we know, again, we have seen challenges in how the loan books are kept. That we keep a very close eye. But also, the law is very clear that the board has a responsibility to actually have a very clear asset review system through which they're able to classify the quality of our assets and make provisions. I think this could be, one of what you are saying, that, and even for us, we have asked ourselves, what else didn't we see? And I think for me, it's an opportunity we have that there are a lot of reforms we'll bring, including today, Julian, you realize that the books of accounts, like the case now we have seen of the union, who signs the books? We realize it's a chairman, treasurer, and possibly one the director. Now, in the complexity that we are seeing in the SACCO businesses, we have to ask ourselves, do these people, say for those institutions who are lucky to have, CPAs in their boards, if you are not a CPA, what are you signing? You take responsibility. And I think we have now seen 2 or 3 cases that now call to action. And that's a conversation that we need from a legal and even a financial reporting from ISPAC, that this has to change, because the finance director, the CFOs have taken responsibility. The CEOs have taken responsibility first and foremost, because even if you say the board are the preparers and they don't append their signature, they could throw the board under the bus, and we find ourselves. So I think it's a wake-up call, and therefore what you're observing possibly, I think we believe is a situation where, because as we said this, and also we are also imploring SACCOs, look, please come out clean if you have any, because at times, remember, we don't manage these institutions. Yeah. They are both CEO and qualified CPAs. If there is any, problem with your SACCO, you better let's clean it up. Yeah.
Okay. Final question. For many Kenyans, their first interaction with formal financial inclusion was through SACCOs.
Right.
That's how they were raised, that's how they were taken to school, that's how they built houses, etc. And many who might be watching this are wondering, where do we go from here? There have been concerns that we could see what looks like a panic in the SACCO sector, etc. In your own view, where do we go from here?
One, thank you very much. I want to assure members that, KUSCCO was a corporate SACCO, so to say. And it is their SACCOs that had invested there. One, the investments, were on average, the industry average is about 10% of the core capital, meaning their deposits are safe. So therefore, no cause for alarm. Don't panic to go withdraw your money, because that panicking, you will actually create a crisis. Because if 10, 20 of us go looking for money for an imagined crisis, then you cause liquidity crunch. So I would say, members, yes, hold your directors to account, ask the tough question, but we want to assure you that from a technical point of view, making provisions, you are actually protecting the deposit. Okay? You are saying, look here, we have a problem, yes, but we are not sure how it will unfold finally, so we are preserving part of the income we make this year, and you do that. That means the deposits are safe. Okay? Now, and over the years, the prudential regulatory framework, one of the key things we have encouraged is provisioning for impaired assets and building capital. Provision, we say, is the first line of defense against risk to assets. Capital is a second. So look at your SACCO, and then to say that is working, you actually look at the liquidity. Is this SACCO having liquidity? And some of the SACCOs, those ones taking a hit, you realize they have 20% and above in terms of liquidity. They have invested in government securities and all that, meaning they have liquidity reserve to cushion the risk against, going to the cascading to the members. So I want to assure members of the public that from the analysis we have done, we had 201 SACCOs that had invested in KUSCCO out of the 355 you're talking about. Meaning there is, that, therefore, and the number in totality of it from the total assets, the total asset for the industry, that's about barely 2%. So you're saying there's a problem. It's a serious problem, yes, especially when you look at it from a governance perspective.
Yeah.
Because you are asking yourself, how comes you do not see this? You're just putting money over and over. And I think the report for forensic has a lot for us to digest and see how we reform. But from individual member, a depositor perspective, I'll say there's no need for panic. We need to see change. We need to hold boards to account, because members, they are the owners of the SACCOs. They are the first regulator. Yeah. If you don't hold your boards to account, then they will just be happy and continue doing the same old thing. You hold them to account, then they'll know tomorrow we got to be more diligent in what we do. Because I think some of the exposure you have seen is outsized. Yeah. And therefore, from an individual perspective, I think there is no cause for alarm, no need to panic. And we have taken that in the regulatory guidance we are giving, and the CS has spoken about it. We were very careful, because it doesn't make sense for you to just provide, and then you are insolvent the following day, and then you tell your members, you can't pay you return on your deposits. And mind you, the deposit, like if they are grown, you'll find a member who has saved for the last 20 years. He looks at that, January, I'll sort my couple. So I think we didn't want to cause that panic, and that's why we were very considerate, very prudent in how we manage that. And I think that takes care of the interests of the members who are depositing in SACCOs, and therefore they need not panic at all.
All right.
Thank you.
Mr. Peter Njuguna, thank you so much for your time.
My pleasure.
We have been having a conversation with the CEO of Sasra, the oversight body on SACCOs, and we have been touching on the subject of the exposure to KUSCCO. Remember, no one has broken down this issue like we have. Stay tuned for all the breakdown on any emerging issues.
All right, thanks, Julian Samboko, for that conversation.